The new IFRS standard introduces a 5-step revenue recognition model that was introduced in our first video of this series. We are from Kong Lim and Partners, Chartered Accountants of Singapore, and a member of JHI and Task. And in this video, we will go through the first step of that model, which is identifying the contract with the customer. The first thing to deal with when understanding this step is that revenue can only be accounted for if there exists a contract between the entity and the customer. In our overview of IFRS 15 episode, we have gone through the definition of a contract. IFRS 15 has a few requirements in order for an agreement to be qualified as a contract. Firstly, a contract does not exist if each party to the contract has the unilateral enforceable right to terminate a wholly unperformed contract. Secondly, all contracts must meet 5 attributes at the start of the arrangement in order to be considered a contract with a customer. These have been introduced to you in our overview video. Here, we will go through in detail to what each attribute means and what to do when not all the attributes can be met. Attribute number 1 is that parties to the contract should approve the contract and must be committed to perform their promised obligations. This means that the buyer has the obligation to pay the seller and the seller has the obligation to deliver the goods or service to the buyer. The next attribute is that you can identify each party's rights regarding the goods and services to be transferred. This means that the buyer will have the rights to receive goods from the seller, and the seller will have the rights to receive payment in exchange. Attribute number 3 is that payment terms can be identified for the goods or services to be transferred. Examples of this could be advanced payments, cash on delivery, and other arrangements agreeable in the contract. Next, the contract must have commercial substance. The definition of commercial substance given in the IFRS 15 standard is that the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. It is therefore normal that fees change in your financial reports and accounting records in relation to this contract. The last attribute is that it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods or services that will be transferred to the customer. This attribute is more prominent than past standards for revenue, where revenue would be recognized first and then later collectability would be considered. However, in this new standard, collectability is now the first step in the accounting decision-making process. Hence, if there are doubts of income being received, then there are no grounds for a contract to exist at all. However, sometimes a customer may have already paid for the goods or services even though the 5 attributes are not fulfilled. This now cannot be recognized as revenue and instead recognized as a liability. In this case, the entity shall recognize the consideration received as revenue only when either of the following events have occurred. Number 1, the entity has no remaining obligations to transfer goods or services to the customer, and all of the consideration promised by the customer has been received by the entity as non-refundable, or number 2, the contract has been terminated and the consideration received from the customer is non-refundable. Let's look at some examples to better understand how to apply these attributes. Here we have a seller, entity C, and a buyer, customer D. Entity C sells a piece of land to customer D, who intends to use the land to construct a housing development. Customer D makes a non-refundable upfront payment of $10,000 when the legal title is transferred, and another payment of $990,000 in 5 years when he expects to complete the housing development. Entity C has no history with this customer and the land is an area currently not zoned for housing development. Thus, Entity C is unable to conclude that customer D will pay anything more than the upfront payment. Now, the question is, how much revenue is recognized when Entity C transfers the legal title of the land to customer D? A. $1 million, B. $10,000, or C. There is no contract with the customer. The answer should be that there is no recognized contract with the customer. This is because Entity C is unable to conclude on collectability from customer D. Let's try another exercise. This seller's practice is to obtain written and customer-signed sales agreements. The seller delivers a product to a customer without a signed agreement based on a request by the customer to fill an urgent need. Can an enforceable contract exist if the seller has not obtained a signed agreement consistent with its customary business practice? The answer should be, it depends. The seller needs to first determine if a legally enforceable contract exists without a signed agreement. Secondly, the seller must determine whether the oral arrangement meets all the attributes required to be a contract. To recap, we have just gone through step 1 of the IFRS 15 revenue recognition model. Within this step, we have gone through 5 attributes that must be met in order to consider the existence of a contract with a customer. IFRS 15 also guides us on other related topics, including combination of contracts and contract modifications. Combination of contracts happens when you need to account for 2 or more contracts as one contract, and the standard states that an entity shall combine 2 or more contracts entered at or near the same time with the same customer and account for the contracts as a single contract. However, this is only applicable if 1 or more criteria are met. Firstly, the contracts are negotiated as a package with a single commercial objective. Secondly, the amount of consideration to be paid in one contract depends on the price or performance of the other contract. And thirdly, the goods or services promised in the contracts are a single performance obligation and are not distinct. On the other hand, contract modifications exist when the parties to a contract approve a change in the scope or price of the contract. This may be considered as a change order, a variation, or an amendment, including adding certain goods or services or adding discounts. So, how do we know when an amended contract needs to be treated separately or as a combined contract? A separate contract is required when the additional goods or services are distinct and when the price of the contract increases by an amount that reflects the entity's stand-alone selling price. On the other hand, a contract can be combined when both of these considerations are not met. Modifications to a contract can have 3 outcomes. If a modification adds additional distinct performance obligations priced at their standalone selling price, the modification is to be treated as a separate contract. If, at the modification date, remaining performance obligations are distinct from those already transferred but are not priced at standalone selling price, the old contract is deemed cancelled and a new contract is formed for the remaining new performance obligations. Thirdly, if at the modification date, the remaining performance obligations are not distinct from those already transferred, the revenue has to be adjusted at the date of the modification on a cumulative catch-up basis. This flowchart can help you identify how an amended contract should be treated in relation to the new IFRS 15 standard. Let us look at an example. An entity promises to sell 100 products to a customer for $10,000. The entity transfers control of each product at a point in time. After the entity has transferred control of 50 products to the customer, the contract is modified to require the delivery of an additional 20 identical products to the customer. The additional 20 products were not included in the initial contract. From here, we have established that the goods in question are distinct. That means the customer can benefit from it on its own and not in connection with something else. And now we have to determine if the price reflects the standalone selling price or if it does not reflect the standalone selling price. The price of the contract modification for the additional 20 products is an additional $95 per product. The pricing for the additional products reflects the standalone selling price of the products at the time of the contract modification, and the additional products are distinct from the original products. The contract modification for the additional 20 products is, in effect, a new and separate contract for future products and does not affect the accounting for the existing contract. However, had the price for the additional products not reflect the standalone selling price, and the old contract is deemed cancelled and a new contract is formed for the remaining new performance obligations. For more quizzes and examples on Step 1 of the IFRS 15 Revenue Recognition Model, including combinations of contracts and contract modifications, stay tuned for more videos of this series.